Hello, and welcome to this week's episode of Coinscrum Markets. I'm Nisa. Coming up, Jesse Proudman returns to review the markets in crypto RFQ. I'll be speaking to Santiago, Roel, Santos from Parafi about their fund's DeFi investments. Matthew Pollard from Archax joins Tina to look at the state of play with tokenized securities. And James Bennett is back to analyze this week's Onchain data in Onchain reaction. First, to look at this week's blockchain industry news. Two of the longest established names in the crypto industry announced a partnership last week designed to broaden the appeal for fiat-backed stablecoins. New York broker Genesis Trading has teamed up with Circle, issuers of the USDC stablecoin, to enable yield-generating and lending services for businesses and developers. A recently launched crypto derivatives exchange is set to become the first amongst its peers to be listed on NASDAQ. Hong Kong-based infrastructure firm Diginex is combining its Equos exchange with 8i, a special-purpose acquisition company, or SPAC, to fast-track its public listing. CBDCs were back in the news this week when it was revealed that the next generation version of the Bank of England's real-time gross settlement network designed with support for digital currency transactions in mind, opening up the possibility of a digital pound. Consultancy firm Accenture has been awarded a £150 million contract to redesign the network with a target launch date of 2022. This news comes at the back of the Bank of Governors Andrew Bailey's statement earlier last month that 400-year-old institution was seriously assessing the viability of CBDCs. Bitcoin's breakout 12-month highs last week has woken traders from their slumber following an extended lull in the market. With volatility spiking, Mike Novogratz institutional brokerage firm Galaxy reported an increase in trade volumes not seen since the Black Thursday sell-off in March, with options activity attracting particular interest from their clients. Twitch, the Amazon-owned live streaming platform, popular with gamers, has reintroduced a crypto payments option for its users, offering a 10% discount to subscribers choosing the option. The company first enabled Bitcoin payments way back in 2014 before quietly removing it in 2019. However, with NFTs slowly gaining traction across the gaming community, the move supports a long-held view that the gaming sector is an ideal match for wider adoption of crypto assets. And finally, with the DeFi wave still rolling along unabated, one high-profile voice shed some caution on the much-hyped sector this week. Ethereum founder Vitalik Buterin made some stark warnings in an interview celebrating Ethereum's 5th birthday, saying a lot of people are underestimating smart contract risks, adding he was not confident that even audited platforms and protocols could guarantee that they wouldn't break, and that DeFi yields were unsustainable. Don't forget to click and subscribe to our channel for more updates. Next up, Crypto RFQ. Jesse.
Hi, how are you?
Good, thanks for being with us.
My pleasure.
So it wasn't a huge surprise that following the lowest period of volatility in the past 2 years, the markets finally broke loose last week. What's your take on it? And is this a signal for the longer term direction of the market?
Yeah, it's certainly been an interesting period over the last couple months. Obviously, with the big sell-off in March, a lot of people had broader concern over the health of these markets, and then they've obviously rebounded pretty strong from those lows. May, June, July, we had sort of 100 days for large cap alts where price was pretty stagnant, and 70 days for Bitcoin. We haven't seen sort of stagnation like that since 2018. It was pretty unprecedented. So it is dramatically refreshing to see the movement. Bitcoin is obviously sort of the most talked about coin here, and it's up about 26% or so off its range, depending on where you call that from. But it's been fascinating to watch a bunch of the other smaller cap or smaller large cap coins move. This movement really seemed to be led by ETH, which is up sort of 70% off of its stagnated range, and then Ripple XRP up 58% off its range. So it's been pretty fascinating to watch those markets really pull the rest of the broader cryptocurrency markets with them. And then thinking about sort of more broadly the ecosystem, looking at even smaller cap markets like Cardano or Link. Cardano's up 335% on the year, Link up 439. I mean, these are numbers we haven't really seen since sort of the end of 2017, 2018. So it's pretty fascinating to watch sort of the price action evolve over the last 6-7 months.
And do you attribute that to the OCC announcement, or just what's happening in DeFi or Grayscale, or is it a combination?
Yeah, I think following the March drop, a lot of retail interest shifted from this industry to the stock market. The stock market is very liquid, and you had sort of the Wall Street bets crowd and the Robinhood traders move there. It was a fun place to trade, and sort of rationality, the irrationality that we often see in the crypto markets moved its way over into traditional equities. And so I think that was a big part of the lack of volatility here. Watching Ethereum sort of lead this rally would lead you to believe that a lot of the DeFi hype has helped sort of move us out of this range. I think, broadly speaking, much of the DeFi ecosystem requires usage or staking or locking up ETH in various products. And so that can help drive demand or reduce supply into the ecosystem. And it's sort of the first time where people who haven't worked with a bunch of these DeFi-based applications, if they're now just getting involved in this space, the user experience of these applications is so dramatically different than it was 2 years ago. So a lot of the retail users who may have tried to do things with Ethereum in 2017 or early 2018 and didn't feel like the tools and the technologies are really up to the task or really friendly to use are now revisiting the space and seeing that a lot has changed there. So I think all of that in itself helps drive price, drive interest.
Do you think we can even shift the narrative and say that Bitcoin has moved from a safe haven asset to a risk-on asset because it's more correlated to the market than gold?
Yeah, I think periods of correlation change over time, and certainly over the last couple months or over 2020, there's been a lot of correlation with Bitcoin to the traditional stock market. But I think if you go back to the history of the asset, it's broadly decorrelated. This whole asset class, what we find interesting about it is we just think it sits outside the bounds of the traditional financial ecosystem. So sort of stocks, bonds, equities, debt, all of that sort of operates with similar levels of correlation where cryptocurrencies sort of operate in their own world. And we think that's a pretty compelling component of this asset class, why anybody should have it as part of their portfolio.
And in fact, JP Morgan just issued a report, I think Schwab as well, that millennials have a greater appetite for crypto versus gold, bonds, equities. Do you agree with this?
Yeah, I think that's true. And I think a lot of it just has to do with sort of the digital nature of the asset, right? Millennials have grown up with everything being digital in their lives, and with Bitcoin and the broader cryptocurrency asset class being entirely digital, it's a familiar place. It's a familiar set of tools and technologies that they're already used to. And so it makes sense. It makes sense to the millennial group.
Right. So what about Strix Leviathan? What initiatives are you focused on, or how are you assessing risks when entering these new assets?
Yeah, I think even with the recent price action, this is still a space where you get incredible volatility. And we saw that a couple of days ago with the huge sell-off in the course of 5 to 10 minutes, 15+% or more, depending on which asset, over a very quick period of time. And broadly speaking, this asset class is still very experimental. I think there's a lot of things that people don't understand about this asset class, how the economics work. Even people that have been involved in the space for a long time, we're all sort of exploring and experimenting together. And so as we think about this, it's really important to kind of understand that each one of these assets by itself is an experiment, and each one of these assets individually can effectively go to zero. There is no sort of one currency that will rule them all in this space. I think certainly Bitcoin has the predominant narrative because it's been around the longest. It is sort of the reserve currency of this space, and it's earned that right. But there are plenty of other coins and technologies that may at some point eclipse Bitcoin or may not. So at the end of the day, it's really important to think about this asset class as a portfolio of different assets versus a single coin, and understanding sort of the ramifications of some of these smaller cap coins. Like particularly, you see the numbers in Cardano or in Link this year, and they're really exciting numbers. But at the end of the day, liquidity there is much thinner than in the larger market cap coins. And so if you want to move $100, $200, $500,000 in and out of those coins, it becomes very expensive, where with the larger market cap coins, you can execute with pretty predictable slippage. So there's just a lot of sort of unknowns with the space, and it becomes really important to sort of map your world out as you think about entering.
Great. Well, we will be watching and learning alongside with you. Thanks so much for being with us, Jesse.
My pleasure. Thanks for having me.
With the value of assets locked in DeFi platforms crossing the 8 billion mark and leading exchange Huobi announcing the launch of a dedicated DeFi accelerator, Santiago Roel Santos, partner at Parafi, joined me this week to talk about his fund strategy and motivation for focusing on this particular sector. I'm delighted to be joined today with Santiago Roel Santos from Parafi. Thanks so much for joining us today.
Lisa, thank you so much for having me on the show.
So Parafi was founded in 2018 when DeFi was at its most nascent. How did you come together and get involved with this? And, did you expect all this growth to happen?
Great question. I think Ben, my partner Ben and I, we both come from traditional finance. And so, we've been investing in crypto since 2013. And if you look over the course of that period, what's really where I think the product market fit of crypto has largely been is around transfer of the value, storage of value, medium of exchange. And so for us, naturally, we look at DeFi as a continuation of that. And so certainly DeFi has picked up over the last year and a half in earnest, largely built on Ethereum. But I think there's been a lot of groundwork built over the last 10 years of infrastructure. And I think we're hitting an inflection point that is getting very, very interesting, where a lot of projects have been building and it's gone to a point where, things are ready for prime time. I think people, consumers especially, or market makers or participants in this ecosystem are really starting to see the result of what's been oftentimes has felt like an arduous process to get here, right? Nothing is very linear. I think now things are starting to pick up quite a bit, but it's been a long time in the making. And so Parafi really was started on that basis. My partner, Ben, was at KKR. He was looking at blockchains from that perspective. He was doing distressed credit trading. I was at more of a venture fund called Sageview Capital, which is a lot of the partners at KKR. And so I was investing in open source tech and fintech. And so really I think the thesis of Parafi is really seeing the convergence of what we think is, the power of blockchains and open source, plus really revamping financial infrastructure, which when you think about it, the financial system hasn't really been modernized over the last 20 years. And so I think now blockchains uniquely enable that. And so that's what we're really investing behind.
Yeah, so you have the same venture background that I do. And a lot of what we talk about is risk, right? So Vitalik Buterin said this week that he thinks a lot of people are underestimating smart contract risk. Do you think he's right?
I mean, certainly, the Lindy effect, this notion that the longer things exist, the stronger they become. In cryptography, I think, look, DeFi is a year old or a year and a half old. Some of these protocols haven't been truly battle tested, but I'll offer a couple of metrics. One, total value locked. I mean, I think value in these systems keeps growing, and I think that is a good sign. Just yesterday, there was another hack of Open, which is an options protocol. Things are moving fast. Some will break invariably. One of the companies that we're investors in is Nexus Mutual, which allows you to actually buy cover on smart contract. And so, I think risk management in this space, there's a huge opportunity for people to come in here, develop more robust options platforms, credit default swaps, and then just continue to expand Nexus to continue to grow. I think it's just getting started, but certainly, I mean, to Vitalik's point, I wouldn't necessarily disagree. I think these protocols are still rather young and haven't been truly battle tested. But, there's been a lot of focus in the community to do security audits, have bounty programs, which over time will give more confidence that these systems are battle tested. But there's a lot of risk, right?
Right.
I wouldn't say that there isn't.
What makes some safer than others, and have there been improvements since Black Thursday?
Yes, I mean generally at the smart contract layer, I think we look to at least invest in the most competent technical teams that really understand the different standards. When you look at some of the vulnerabilities in certain protocols like BZX, or DForce, I think in China, DForce in particular, I mean, there was a very well-known vulnerability in ERC, I think 721 standard when you're using it in an AMM. Not to get too technical, but I think that was just an oversight of the team that could have been corrected had they sort of really understood the vulnerability in the standard. So I think all of this to say is I think that the competent teams recognize that it's important to do audits, not one, maybe two, continuously do audits and have a bounty program to incentivize white hackers like Samsung to go in there and try to battle test the system, and also do a methodical rollout of the protocol, right? It's not like software world where you launch your MVP, move fast, break things does not work in DeFi. You have to be slow, you have to be systematic, you have to contain the risk. And so I think almost the smart teams recognize that you want to launch in a very systematic way. Like your beta should be contained, there should be low, small dollars at work, and then over time, kind of roll it out, right, in a systematic way, as opposed to some teams that just are like, look, we want to capture the market, we want to be aggressive at the expense of potentially being hacked and then consumers losing their capital. So
right. And even with liquidity pools locking, you could even see the scenario where a DEX might shut down, right? And that hasn't happened yet. That hasn't been stress tested yet.
Definitely. Yeah. Word of caution. I mean, anything that promises and looks too good to be true needs to be looked at with a lot of scrutiny.
Yeah.
But we're getting there. I think a broad statement that everything is super risky in DeFi, I'll counter back by saying, unlike the traditional financial system, everything is open, everything is transparent. And so you can actually monitor on-chain activity. You can see the total number of funds locked, where they're coming from, flow of funds. That is a great opportunity to price risk in a way better way that you could in traditional finance.
Right.
I mean, go back to 2008, you had exotic derivatives, off balance sheet items that there was no way to pricing these things, but now you do. And and I think let's take that and use it and price risk accordingly, right? And so I think that's a huge opportunity that we're looking for teams that are like Nexus that are leveraging that. Yeah.
But it's a little difficult to explain it to, you're spinning out a pure fund in this sector. How do you explain that to people that don't really understand the sector at all, right? What kind of, LPs do you have?
Great question. Yeah, look, we've been having conversations with some of the largest asset managers and pension funds, university endowments, and the likes that are crypto curious and have been for the last couple of years.
Right.
And when they ask us about DeFi, really our response back to them is, think of this as the next arc of innovation of fintech. Forget for a second about crypto. Forget for a second about blockchain. Know that fintech is moving in this direction. Why? Because it's a secular trend. Like if you look at the internet, there was a time where we refer to businesses as internet and non-internet.
Right.
Now every business touches the internet because it's great technology, transformational technology gets adopted. It's too hard to ignore, becomes an operating standard. The same way that the internet has permeated every aspect of our life, commercial, business, non-business, personal lives. In the same manner, I think we're not far from a state of the world where people are interacting with DeFi applications without even knowing it. And I think that's the beauty of powerful technology. No one cares about crypto. No one cares about blockchain. At least that's our pragmatic approach to investing in this space. People care about the bottom line. And I think that's how we convey the opportunity in DeFi. It's very early still. The financial system has been stitched together and cobbled together in a way that has somehow worked, but there's a huge opportunity to be a step function improvement. And I think the nice thing about finance is the ROI is very clear. A trader understands slippage. He understands liquidity. Right. And we're seeing an influx of centralized, what we call CFI, so centralized finance in the crypto sphere, entering DeFi because they can make more money. They can be more capital efficient. And that, I think, we're just seeing the early signs and indications of traditional finance entering DeFi.
What do you think about these various forms of collateral everybody's looking for? What about real world assets potentially as collateral? Thoughts?
Oh, certainly. I mean, that is sort of a holy grail. You have a couple of projects like trying to bridge real world assets into DeFi, into digital sphere, like Atoms, Meet, Bits. We're excited about that. I mean, it's a huge market. A company like a protocol called Centrifuge is trying to do this, where they're collecting invoices from high quality, corporate issuers and putting the accounts receivable on the blockchain, and a hedge fund or a counterparty can go in there and buy cents on the dollar and take the counterparty risk. It's going to get very interesting, I think. Mm-hmm. Collateralizing things other than crypto collateral. What is quite interesting is the price discovery of how you price these sort of illiquid assets, right? If you look at the beauty of AMMs is that you have good price discovery on things that otherwise were quite hard to have good price discovery on. So now you can tokenize X or Y, and that creates a market on some of these illiquid assets and opens up the market opportunity.
Right, and then you have the price discovery through the aggregators in layer 2 as well.
Exactly. Yeah.
So what are the best ways to incentivize liquidity? You have Uniswap as an automated market maker. You have zero knowledge proofs to reduce gas fees for market makers. Like, what should we be doing?
From an incentives perspective, I feel, certainly you have what we've entered into an agricultural revolution of sorts that we call, liquidity mining and farming. We view that as a great customer acquisition strategy for these protocols. You look at what Compound has done, Synthetics has done, Balancer, and UMA, and I think most projects are shifting that direction of incentivizing the core users of the protocol, whether it be supplying assets for lending and borrowing, or borrowing in the protocol and rewarding them with a native token. In many ways, it's no different in my mind than a startup granting equity to employees or key people. But you've never had this paradigm. It's like, think of Uber, right? In a state of the world where Uber could do this, I think they would issue equity not only to employees, not only to investors, but also to drivers and to passengers. And I think that's sort of the analogy that's happening here with these incentive programs. If you were to zoom out, the key innovation of blockchains, I think, full stop, is the token itself, because you have never had a more powerful coordination and incentives mechanism. Full stop. And I think whatever your KPI is, whether it's increasing loan and borrowing activity in your protocol, if you're Aave or Compound, trading activity, it becomes the way to bootstrap these networks is just the cost to bootstrap them has gone dramatically down. Mm-hmm. Because you're rewarding everyone in the ecosystem. And I think that is the beauty of blockchains. That is the beauty of tokens. That somehow the narrative around tokens got lost in 2017 around scams and ICOs. But the true novelty is, at the end of the day, we are it's the best coordination and incentives mechanism.
How do we bring in more retail, or are you concerned about regulation with retail investors in this space? How do we democratize it more, that it's not, a house of whales here?
No, it's a great question. It's something we think about a lot, regulation and protecting consumers. I think we're still sort of in the experimentation phase where things can still break, to your point on risks. So it's important to, be very projects and us really just, it's on us to kind of protect and use a buyer beware kind of thing. But there's another element of like power is, I think crypto generally is a retail phenomenon. A lot of people talk about institutions getting in the fold, but it hasn't, I think will continue to be a retail phenomenon. And that's a paradigm shift. Anyone can be a market maker. Anyone can be a liquidity provider on Uniswap with any amount of funds, right? You don't need to be a large trader. You don't need to be a large hedge fund. You can get a nice yield and be a market maker on any amount. And that, I think, collapses the barriers to entry. You can run arbitrage strategies using flash loans with Aave. I mean, you've just never had that environment, because this notion, it takes money to make money. It takes a large balance sheet to really play with the big boys and the whales. I think that is true in traditional finance. You need a prime brokerage account, and you need to be ultra high net worth to get access to derivatives and products that, offer better investment returns, more protection in some ways. So, don't get me wrong. I think there's a lot of education that needs to happen. Not everyone should be buying and levering up 10x or doing yield farming or buying derivatives or options. Certainly not. But I do think that in another state, the fact that you can do that is quite powerful, because there are very smart retail investors that, I think it's a misnomer to call it retail. It's just, are you sophisticated or are you not sophisticated? There are large institutions that are not sophisticated. There are retail investors that are very sophisticated.
Right.
So it goes back to this, like, definitionally,
of accredited investors. Yeah.
That's exactly right. Like the fact that you've made like $1 million or like have earned over 250K or per year is a very antiquated construct to determine if people are knowledgeable, sophisticated. Let's better instead ask them questions. Hey, do you understand how a put option works? Call option works? Do you understand liquidation? Do you understand that your collateral? Those are the things that need to be perhaps more emphasis on the educational side, as opposed to having these very rigid definitions that candidly just don't work. Yeah.
Well, great. Thanks so much for joining us today, and we look forward to future conversations.
Yeah, no, Lisa, thanks so much. I really enjoyed this discussion, and if people want to learn more about us, they can reach us. We're typically on Twitter, or reach us out at Parafi Capital, and we'd love to talk to you.
Great. With DeFi grabbing the spotlight, the excitement surrounding tokenized securities has fallen a bit back, but Archax, one UK-based startup to enter the space early, has stayed the course. One of their founders, Matthew Pollard, joins to discuss their state of play. I'm delighted to be joined today by Matthew Pollard, co-founder at Archax. Matthew, how are you?
I'm very well, thank you. How are you doing?
Great, thank you. With all the attention DeFi has gotten lately, how have security tokens fared, and what's happening at Archax?
Yeah, so DeFi is a very hot area at the moment. It feels like security tokens really started to come to the fore in 2018, and lots of work has been going on all across the world in the security token space. There were the first movers like T0, and then there are kind of other exchanges across other countries, including Archax. And I think you'll see, if you look at the security token space's market cap, and if you look at the volumes, you'll see a trend upwards. And I think the last 3-4 months, it's really started to explode the space, I guess, as people get a bit more familiar with what the technology means and how to interact with it. And I know that the T0 token and the Overstock token have both performed extremely well over the last 3 months. As it relates to Archax, so we started this journey in February 2018, and the goal was to build a regulated venue in London that ticks the boxes for institutions to get involved in trading things that exist on blockchain, whether that's Bitcoin, whether it's security tokens. And our focus for the last 2 years has been on securities and security tokens. And the remit of the venue is split into 3 buckets. One is we have gone after permissions with the regulator to become a broker. So we can arrange deals and make deals. The second is we've gone and applied for permissions to be a custodian. So we're going to be CAS 6-7 custodian, which means we can custody client cash and we can custody our clients' assets. And our clients' assets are on the blockchain. So we are like a bank, but we don't have a full banking license. And then the final, most important permission that we've gone after, and that's been the most complex and has never been done before, is to have a multilateral trading facility designation, which is an exchange designation in Europe for securities that exist on blockchain.
Excellent. Congratulations. So
thank you.
How does this compare with what's going on with other regulators, say BaFin's moves in Switzerland, the SEC, everybody rushed in to become a transfer agent here. How do you compare what you've achieved?
Sure. So I think let's go across country by country. So Germany, BaFin has been involved in approving some prospectuses. There was a direct-to-retail property security token that I remember hitting the news. Great to see. The fact that there would be a prospectus put together that would involve the raising of funds direct from retail, and the end result of that would be a token that exists on blockchain that represents your kind of share of ownership in this project. Great to see. Now in the US, yes, you've seen places like Vitalo, Securitized, TokenSoft go after the transfer agent designation. Amazing to see, using blockchain technology to issue security tokens, and then the private trading of those security tokens can be recorded by their in-house transfer agent. The kind of next logical step of that is to have the securities listed on an exchange for multilateral price discovery, so many to many, and that is what T0 is trying to achieve with their joint venture with the Boston Stock Exchange. So if you look at public filings, you'll see that that joint venture, they probably put for comments to the SEC Q3, Q4 last year, and the SEC's come back once, maybe twice, asking for comments. There's been comments from NASDAQ, there's been comments from other players in the space saying, this is what we think. They're very interesting reads. I recommend them to anybody, and they're public if you go on SEC Edgar. So if and when T0 pull that off, that will be the first, per my understanding, multi-to-multi price discovery venue in the US using kind of the Boston Stock Exchange's setup. And then outside of Germany and the US, talk out of other jurisdictions like Liechtenstein approved a multilateral trading facility recently for crypto, but not for securities. That's a key differential. Switzerland is always far ahead with their thinking and their documents and their prospectuses. I can't think of anything off the top of my head around kind of approval, but obviously Switzerland has SDX, a massive company with loads of resources who've done amazing things with R3 Corda around the kind of front to back capital markets, blockchain issuance stuff.
Right. And then the regulator doesn't really have jurisdiction over which technology you choose to use, right?
Yeah, that's right. So the FCA say that they are technology agnostic. And, I've dealt with the FCA in my previous career. I was involved in hedge funds. I was involved in regulated activity. And so, I've done things with the FCA before, but going through this process across all these different permissions has certainly been an experience. And the FCA they are technology agnostic. They want to make sure people are protected. They want to make sure that you're doing things the right way and you're following the regs. But they also want to embrace innovation. And if you look at the amazing FCA sandbox, you can see that they're now up to the 6th cohort, and you can see the kinds of companies that have gone in across the prior cohorts, that there are blockchain companies in there. Now, we spoke to the FCA at the beginning about the FCA sandbox, and because of the size of our application and the complexity of the 3 different areas that I spoke about earlier, especially the multilateral trading facility, we did not go in the sandbox. We instead have a case manager at the FCA, and we have kind of relationships across the different teams that we've built on, and we've engaged with them over the last 2 years. And so if we ever wanted to kind of take our permissions and do something very discreet end-to-end with them, then we would apply to go in the sandbox. But for now, for all the things that we want to do around security issuance and security custody, we think we have everything we need. But yes, they are They are technology agnostic, and they have a track history of embracing innovation for sure.
So let's switch gears and talk about the demand side, because traditionally you would hear most investors saying, well, there was no demand because the assets that were coming to market had an adverse selection issue, or the people who would normally buy these tokens are really just interested in crypto trading, or you'd hear various narratives. What actually, can we debunk those myths now, finally, and say, that the demand side has picked up? And if so, then what particular projects have been the most interesting?
Sure. So it's definitely a nascent space. It's definitely a nascent space around the wrapper, the technological wrapper that is security tokens. So bring a security into existence that exists on a distributed database in a regulated way is a nascent space. And so there are kind of hurdles to people understanding how things need to be done, but you've just got to see the great work done by TokenSoft and Securitize in the US and GlobalCap in the UK to see that it's a process that's seen and respected by the SEC and the FCA respectively. These guys have done great work with them. We have had our ear to the ground in the space over the last 2 years, and we have 5 or 6 companies that have pre-listed to list with us when we go live, and the total asset size of those is in the hundreds of millions. So there are companies that want to raise capital because capital markets is hundreds of years old. It's a trillion dollar industry. So that side of the funnel is never going to go away, okay? So the leap is taking the capital markets industry and thinking, how can we make it quicker, reduce friction, reduce cost, and over the life cycle of this security existing, how can we show everybody that doing it on blockchain is better? What this space needs is more interesting assets. How does it get that? This space has to infiltrate broker-dealers. It has to infiltrate traditional finance. It has to infiltrate that acknowledged and growing trend of less and less companies going fully public. Right. Less and less companies are doing it. It takes X time. It costs Y. And some companies just don't want to do it. So they either stay private or they kind of do this hybrid model, or they do a direct listing like Spotify.
Right, or a SPAC.
Exactly. And that's another thing. So It's my understanding that Archax as a regulated exchange can list anything from the traditional world as well as things with blockchain. So I'm looking at SPACs. I want to see what we can do with them in terms of listing, because I'm very excited by the thought of a blockchain-focused SPAC listed on Archax specifically. I think that's pretty interesting.
Yeah, so, that will definitely happen soon.
Yeah.
And then, there's also the convergence with DeFi, because as the momentum builds there, you can have some real-world assets as collateral as well. Sure. And I think that's a space that only a few people have explored thus far. So there's a lot of growth potential.
Yeah, so I try and keep my ear to the ground in the world of crypto. I have participated in DeFi. I don't know what goes on under the hood, but I know how to navigate the UI UX. I know how to keep myself safe. I know how to read contracts on Etherscan, but I'm nowhere near the level of these innovative guys in the space of DeFi. Mm-hmm. But when you strip it all back, lots of the DeFi venues are non-custodial ways to transfer value that completely remove traditional financial architecture. And if you go at a high level, I view them as like smart contract banks. People put assets in, people take assets out. There is a cost every time a transaction happens. And rather than cost going to the shareholders of a bank and to pay staff, it goes to the miners that secure the network and the people that have designed the smart contract and the people that have contributed assets to the system. For me, that's why DeFi is absolutely amazing. Yeah. However, I must urge caution from a regulated point of view. So I'm interested to see what happens in the space around non-custodial smart contract powered venues, but that look at things like AML, KYC, and the and the nature of the returns and the nature of the yield. So, Archax with its permissions can and maybe will create a non-custodial lending and borrowing venue, but it would be a closed ecosystem. Mm-hmm. So the depositors would be known and the borrowers would be known. Mm-hmm. But still, in terms of speed and efficiency and it all being powered by smart contract at that point of borrow lend, it's still really exciting. It's a really interesting space to me, for sure.
Yeah. And you and I are also part of a committee under GDF that's in enlisted institutions to get involved in moving this industry forward. So that's also very exciting.
It's amazing. So I've been part of GDF for 2 years maybe, and I actually co-chaired the security token working group with John Salmon from Hogan Lovells, and we had 80 or 90 members back then. Right. From places like Circle and Coinbase and banks and law firms. And we kind of had to marshal everybody's ideas from all over the world. And we put together the GDF security token attestation, or whatever, the code of conduct that you have to attest to if you choose to. And now to see this latest thing coming from GDF, there's even bigger names there. So this space isn't going away. And I've been talking to banks and law firms about this since I started the Archax journey, and I've also been learning along the way. But banks look at this as a potential threat to see how they're going to be disintermediated by firms that embrace blockchain quicker than they can do because they are an incumbent. Right. But they also see the creation of securities on the blockchain as a potential cost saver for them as a business.
Right.
So if they start dealing in client securities and custodying client securities and trading client securities, all that exist on a blockchain, they think from a middle and back office point of view, there could be savings there. And one of the Archax, one of the concepts of Archax is that the output from the trading on our regulated venue will exist on a distributed ledger, which means the people that buy, the people that sell, and those respective buyers and sellers, prime brokers, administrators, key interested parties, they can be given permission to see the output of our venue on that distributed ledger. So then you have this kind of, rather than everyone sending files to each other and reconciling down this chain of service providers and stakeholders in traditional financial services, if people want to, the output from Archax in a permissioned way, powered by R3, will be there for everyone to see. And if people embrace that, and it's obviously up to the institutions to embrace that, we think it could be quite interesting.
Yes, and hence the amount of banks on our committee now. Right. So we'll just leave it with transparency, automation, liquidity, and 3 simple things for people to remember. Thanks so much for being with us today.
Thank you, Nisa. Bye.
Next up, James Bennett is back for this week's Onchain reaction.
Thanks, Nisa. So on the Bitcoin network this week, we've seen the highest level of transaction value that we've seen in the whole of 2020. So looking at it on a 7-day moving average, we've had $4 billion of settlements per day over the last 7 days. You can see from the light blue line at the bottom of this chart that the settlement value per day has been trending upwards since January and has really spiked over the last week or so as price has surged up to that $12,000 level. We've had a few days between 4 and 5 billion and a couple of days over 5 billion, which really happens only sort of once a quarter normally. And this week we've had about 3 days where that's been the case. So there's a lot of activity taking place, which is of course bullish for the overall network. Now, if we look at network velocity, which is essentially the amount of coins or the speed that coins are moving around the ecosystem, it's a similar thing to transaction value, but taking away the dollar price and just looking at the movement of the coins. We can see here that velocity is now pushing back at that 600% level, meaning those coins move 6 times per year. I really like this chart because it shows the relation between velocity and price from the beginning of the year up until now. So starting at the far left, we can see as velocity sort of climbed from those lows of about 480, 500 up towards 600. The price then followed. As velocity dropped in May, we can see the price also dropped. And then as we had that steady rise between April and June of velocity from 600 up to about 650, 680% was the peak, then price also followed suit. And then finally, as we see from June going down into August, just before this latest let's say short-term bull run, velocity has been dropping, and that's led to price dropping. So it really clearly shows the relationship between the amount of times or the speed that Bitcoin are moving around the economy, which is the sort of demand on chain, and then that impact that has on price. So it's one to look out for. So now moving into the miners industry, we can see that fees continue on their upward trajectory. They peaked at about 18% of total revenue. Now, outside of halving, that is really quite impressive. They're now well over $10 million per day of revenue for miners, so nearly $2 million per day just through fees. Again, that's a sign that a lot of people are trying to use the network. We're seeing that block times are quick. So it's not about sort of having not enough having congestion on the network because of a lack of new blocks coming through. It's actually just this surge in activity that's taking place. So we've got more transactions taking place, which means that Bitcoin are moving faster around the ecosystem, and that's all positive and driving up price. Finally, we're going to have a quick look at the MRI, the miners rolling inventory. So this is basically the difference between what miners are generating and what they are then moving from that wallet that they've generated. So when the line is going up, they're essentially selling off their inventory or moving their inventory away. And when that line is going down, they're building up their inventory. And what we can see here is there was a sharp spike from mid-July into August. August, sort of early August, late July is where they really capitalized on this surge in price up to the 12k mark and sold off their inventory. So you can see that really sharp upward trajectory of the MRI hitting 106% peak as miners took advantage of that firm bid in the market. We're currently sitting at about 101%, which means that miners are continuously sort of dropping their inventory or selling their inventory, moving their inventory into the market. We'll wait and see what happens next. As long as there's a strong bid in the market, we expect miners to take advantage of that. When the bid drops off, price starts to look weak, we typically see that miners will hold back on their inventory and wait for brighter days. That's all from Onchain Reaction this week. Back to you, Nisa. Thanks.
Thanks, James. You've been watching Coinscrum Markets. Thanks for joining us. See you again next week.